great to have you back, Rebecca. We did see some outperformance in the month of January, which was so painful for U.S. equity investors in places like Hong Kong or the U.K. Is that the right bet to go overseas now?
Well, I think the U.S. is in a bit of a difficult position because the U.S. markets have gotten more sensitive to liquidity conditions in recent years. So now that the Fed is signaling that it's going to start pulling back on liquidity, you've got more market weight, if you will, in the U.S. stock market that is going to be pulled down by this pressure. So if you look overseas right now, as we have reopening, hopefully as Omicron passes quickly, you're going to see economies taking off some cyclical support, but you also have economies overseas at much better valuations with central banks that have a lot less pressure to remove the liquidity or at least move it more slowly than the Fed. And so I do think if you're looking at places like Japan, much more geared towards the cyclical recovery, not much pressure on the Bank of Japan right now to do anything but stay where they are. Places like Europe, the valuations aren't quite as attractive, but also the ECB moving significantly more slowly than the Fed, and fiscal there's still support, in contrast to the U.S., where it's starting to become a net drag on growth this year. So I do think there's a good chance this year we're going to see non-U.S. markets, generally speaking, doing better than the U.S. Not to say the U.S. is going down. I think it's just going to have a harder time if we end up getting five Fed hikes, say that 5 times fast, and possibly our view is inflation that's going to be significantly higher than what's discounted.
So that's what I was going to ask, is whether you believe all of that is sort of a dangerous recipe for bulls in the U.S. this year, that it'll be continue to be driven by liquidity coming off and higher interest rates and worries about inflation.
Yeah, we're in this really interesting place. I mean, this cycle is so different than anything else we've lived through, certainly in our generation. You've got this incredibly strong nominal demand, nominal economy, and that's supportive for earnings. At the same time, you have this very high inflation, and that's pushing the Federal Reserve to pull back. The Fed is going to be careful how it pulls back. It saw what had happened in 2018 when it took a step too far, 20% fall in the S&P. It's going to be nervous about how the pandemic continues to evolve from here. It can't have a lot of uncertainty about its data. And of course, as I mentioned, the fiscal going from a net support to a net drag. So if the Fed lags these strong economic conditions, you're going to have higher inflation. And then what companies can pass that through to their end user and keep margins high? If the Fed goes what it needs to do, it's going to tighten faster than what's priced in. I think that'll be a continuing downward pressure on some of the growth, longer duration names, which is, a large chunk of the overall market today.